About a year ago, we had a change in the tax law that kept all of us estate planners just excited for months. It was the first major change since 2001, when W came into office. American Taxpayer Relief Act. President Obama signed it on January 3rd. That is the biggest news of the whole year. We're still digesting it, trying to understand what it means for all of us who are involved in estate planning. We thought it was going to drastically change what we do for planning. In our office, in our practice in Montana, it really hasn't made that many changes. And the reason is that estate planning is not just about taxes. Yes, that's one of the main issues, but a lot of what we do does not relate to taxes. And the planning that we had done in the past just happened to have the beneficial effect of accomplishing tax purposes, but then other purposes. So even though the tax situation for many people has changed, we're still largely doing the same planning that we were before. So today I want to give you a little update on our firm. I know you'll be excited to hear all that. Talk a little bit about the Peace of Mind Protector program, and then talk about these law changes and what it means, what options you want to be thinking about as you go forward. Our office, I think probably everyone's been to our office numerous times. We've had some changes over the last year or two in team members. We've had a great team for years, and we've been lucky. People have left, other people have come, and they've been just as great as team members. The person whom I want to start with is Jeannie Myers. Many of you may have met her. She's not getting involved directly in the estate planning as much as she is in the estate administration and probates. Her husband is one of the owners of Flawless Auto Body. She worked there for 8 years. She's great with people, and she is just doing a great job helping us with our estate administration. The biggest issue that we have once we get a plan designed and signed is trust funding. It is a tough job. I go to all these seminars, and some law offices say, oh, we don't get involved in that. We just tell the clients what they have to do and they just do it. And we never had a problem. I just cannot believe that. Because we're working on making sure the assets are titled property, the beneficiary designations the way we want them to be, and it's still a challenge. We had a client die up in Whitefish about 2 months ago. We just finished their plan last year. The CPA was involved intimately in all the work. Very business-like people. We were crossing every I, dotting every T. Passed away. We found 2 assets that he forgot about. So funding is a huge issue. And we've had some good people in the past. Luckily now we have Teresa Eads. Teresa has a background as a bookkeeper, so she's really good at the detail. She's doing our bookkeeping for us, which isn't really a full-time job, and helping with trust funding. So if you haven't already talked to Teresa, you will. She's from out at Ulm, from a farming family out there. I don't have a picture for Megan, our new receptionist. She's a great young gal. She's just finishing college. I'm not sure what she's going to do. But I do have a picture of Tanya going to Hawaii. If anyone called our office in the last year, they heard about Tanya going to Hawaii. She's been planning this, well, maybe it's more than a year. It's probably more than a year. When she turned 50, she was going to Hawaii. Her boyfriend, Jim, was taking her to Hawaii. End of case. Well, he did. And you can get the history of it now from Tanya, but that was a big event in our office. My partner, John McCarty, most of you probably know him. You may not know his wife, Rhonda McCarty. She was a principal, great principal. She decided to leave the school district and go to work for Easter Seals about 2 months ago. So there's a lot of change right there. She's excited about that. She's the chief operating officer for Easter Seals, which is based in Great Falls. It's for the whole state. It's a big job. I know she's up to it, but it's a big change for the McCarty family. For the Tokerud family, The big deal was our daughter Hannah graduating from law school, passing the bar, and now working for a year down in Helena for the Supreme Court. She's actually clerking for Pat Cotter, who's from Great Falls, a friend of mine, great lady, and Hannah's learning a lot. She's close, she's coming this weekend. Life is good in the Tokerud family. The Peace of Mind Protector Program. As I look back over the last year, I think we've made a good start. We have helped a lot of people circle back around and look at their planning. You know, when I sit down with every family, I've done this for 10 years, I say, estate planning is a process. We need to get back together, stay on top of this because things are going to change. Everybody always shakes their head. Okay, doesn't happen. Through this program, and otherwise, it's also stimulated us to maybe reach out more to other people to update their planning. We've done a lot of updates of plans, which means for the trusts, we've looked at who we've named for our backup helpers, our successor trustees. That's one of the hardest issues in the planning. Who are we going to name? Everyone is concerned about family politics and not offending children and the older being bypassed for the younger and what that means. Rightfully so. I'm concerned about naming someone who may be the greatest kid in the world but doesn't even know what a trust is. When a trustee job, particularly for people who have estates like most of you, that's a job. So one of the nice benefits to me of the program, it's given us a chance to go back, and now that we're a little more aware of what the whole program is, to look and see who the trustees are and do some tweaking. Number one. Number two, also to step up our communication with the people whom we've named. When I'm helping people with their planning, I say, let's not stop and go and get everybody's approval to name them. Let's just name them. And if they don't want to serve when we talk to them, okay, we'll change. Hardly ever happens. But we do want to talk to our successor trustees at some point, get them on board, maybe invite them to a workshop like some of you have, communicate with them. That's happened as a result of this program. I'm really happy about that. We've also had a chance to talk about some additional planning for people. You know, our hands are full with the planning that we do to get the trust in place and the ancillary documents. There's a lot of decision making, as you all know. And then when we talk about the asset ownership and the funding of the trust, that's a big job. It means that we have to defer and not focus on a lot of other issues that people have. Well, as a result of our program, we've had a chance to circle back and talk about some issues. So for instance, one of our farming families from northeast of here, they've had a farm and a ranch for a long time. The farm and the ranch owned by one entity. We've got the operating entity owning the assets. Probably not a problem. But if there's ever a lawsuit, it's going to come up from the operational activities, not the land. And if there's a lawsuit, we'd rather not have the land have to pay that judgment if possible. So from the lawyer's standpoint, from the asset protection standpoint, we'd like to have the land owned by one entity and the farm being operated by another. They got an agreement back and forth. And if the operating entity gets sued, at least we're not going to lose our land. From the lawyer's standpoint, I like that. From the CPA standpoint, they like the fact that we can have a lease agreement back and forth, allocate our expenses such we can have the operating entity be taxed as a C corporation. We don't want a C corporation owning land, but a C corporation has one nice thing. Up till $50,000 of income, it pays very low income taxes. So we didn't have time to get into that before, but now we've had a time to get into that with the client. We're setting up those two entities, going to save them income taxes, and if they ever do get sued, we've got a better chance of saving the biggest value of the family has, the land. Not bad. Another family here in town that we're working with owns a very successful business in which two kids are actively involved at a management level. Some other kids are more or less employees. What's going to happen to that business? How are we going to keep it going? How are we, when we have a bunch of kids, going to avoid World War III when Dad's gone? Well, there's some planning that we can do. It's actually one of the last points I want to get today as a strategy for people to think about when we have an estate tax issue. We can start during our lifetime transferring shares in that business. We can sell them with no income tax consequences. Get them out of our estate, have a sale, but no income tax consequences. No capital gains, zero. Not bad. It takes a while to get your mind around that. You're not going to have a chance to talk about that when you're busy signing revocable living trusts. But when you have time, as we do now, to look at our planning, might be something that we can get our mind around and institute. So I'm pretty excited about that. I also like our workshops, if I may say so. The first workshop last year, we talked about law changes. Let's see. What was the one? Next one was, I've got to remember. Oh, how to get health care, how to get the best health care. I don't know about you, I learned a lot about health care. And I'd just been through a lot with my wife Becky, having had emergency appendectomy over in Missoula, 2 surgeries. I learned a lot. I hope you did too. The last presentation on ethical wills. Here's my mom, my daughter Hannah, my 2 nieces and my nephew at my sister Charmin's wedding on Labor Day. Labor Day. My mom looks pretty good, doesn't she? She was pretty good. Went over to her condo on Sunday. She knows who I am. She knows who my sister Meredith is, who's taking care of her. She doesn't know where she is. She doesn't know when she gets to go home. She doesn't know what she's supposed to do. Probably everybody in this room has had that experience. My first time to really have it with a close family member. I have been talking about capturing family legacy, ethical wills for a while. We had a presentation on it. Did I do my job and really debrief my mom on family history like I should have? No. And it's too late now. So I'm really happy that we had that conversation a couple of months ago. And Ron, if you don't mind, I'm just going to brag a little bit. Here is an ethical will in picture form done by Ron Hall of a very important part of the Hall family history, skiing up at Showdown and so on. Ron came to the workshop and got busy and got carried away in a great way. That's really neat, Ron. You gave it out to how many family members?
20.
Nice. That's great. That's really good. I'm proud I helped you do that. So I think the workshops, to me, have a value in allowing us, again, to think more about estate planning beyond the basic planning that we did. And we can all do better at all given times. That's the first year of our program. Well, what about coming up? Yes, we've updated trusts, ancillary documents, funding. We've done additional planning. The next workshop I like to put on in about 90 days is to talk about what I'm calling end-of-life healthcare planning. And what I'm talking about is when we get to that last stage of our life and it's a choice between staying in Missouri River Manor or being able to go home, if we can afford to do so, if it makes sense, we need to plan for that ahead of time or it's not going to happen. And the impetus for my wanting to do that is 2 different farm families that I dealt with. One of them, my mom and grandpa went to high school together. We've known the whole family all through the years. Grandpa was doing pretty well, about age 85. All of a sudden he ended up in the hospital, ended up in Missouri River Manor, just that fast. Very large, maybe about an $8 million estate. He was still sharp. He had these issues. He needed medical care, but he wasn't in extremis, as they say. He hated that place because of particularly the noise. Just a barrage of noise the whole time. He's used to living out on the farm. He wanted to get out of there. He had a great wife, great family, a very loyal, loving son. There was no way he was going to get out of there and go home. The family just couldn't get their mind around it. The physicians feel they can give the best care when someone's right there in the facility. That's where we're going to get the best care. Okay, that's a criterion, I admit that. They're not helping us figure out another alternative. And we have an $8 million estate. If I'd had this conversation with that client back when he was healthy, I'm not sure what he would have said. I know he would have said, I don't want the family spending a whole bunch of money on my health care and so on. But maybe he would have said, you know what, if it's possible, I would like to die at home. And if it means we use up part of the $8 million, my kids and my wife can probably get by on a little less than $8 million. What's the magic number he would have wanted to set aside? I don't know. What's reasonably required? I don't know. But in about 90 days, I want to have some ideas to discuss about that. I think that's a huge issue. Maybe not for everybody, but I know it would be for me, and I know it was for that guy. So that's coming up. See what you think, whether it really is something that's of interest to you or not. Okay, we came here to talk about law changes. And I already told you the biggest law change that we had last year was the American Taxpayer Relief Act. And the main change that it made, oh no, stop. I forgot about a little law called Obamacare. I don't want to spend a lot of time on that today because frankly I don't understand Obamacare. And it changes so fast and it's going to keep changing so fast that I don't feel I can really add too much value here today. I did consult with somebody who's very involved in this area, and I said, I'm going to be talking to people of this demographic, what should I tell them? And you'll see in your outline the main points that he suggested. In other words, for us, Obamacare is not a train wreck on a basic level. I'm not talking about society, I'm not just for people who are already or getting close to Medicare eligibility, it's not a train wreck. Let's just leave that alone, if you don't mind today. I can't add too much more value there. But going back to the American Taxpayer Relief Act, the big change was the exemption that law said. Before your family owes any estate tax, your estate has to be more than $5 million, and I'm going to index it for inflation so that this year the $5 million's up to $5,340,000.
How much
Question?
is that indexed every year? Does it go up percentage?
It's a consumer price index change, Paul. Yeah. So the federal estate tax, you'll recall from our discussions, Uncle Sam says, when you pass away, the people whom you've named as your representatives, if you have a trust, your trustee, needs to inventory all your property and get it valued. Piece of cake if it's public securities or a bank account. If it's real estate, you need to get it appraised, or a business. And then you'll have some deductions. You'll have deductions for professional costs. Anything that you give to your spouse in a certain way can be deducted. Anything you give to charity can be deducted. What's left over will compare to the federal estate tax exemption amount. And when we're doing that, just to make it really interesting, we'll go back and we'll figure out what really big gifts you gave in the past, and we'll treat those as still in your estate and figure out what the tax would be based on what you had when you died plus the value of those really big gifts minus the exemption. That'll be your taxable estate. Whatever that taxable estate is, no big problem. Just in 9 months, send us a check for 40%. Well, a $5 million exemption index for inflation is a huge thing because most people, particularly with some planning, can come under that. And it's per individual. So with proper planning, a couple can shield 5.3 million times 2, 10.6 million, a little bit more. That's the main change, as far as I'm concerned, of that tax act last year. What it means is, when we're doing the planning, as I'll get into here in a little while, if we're below a certain threshold, we don't really need to worry about estate tax given the law right now. Now, we never know what's going to happen in Washington. And there's this little thing called the deficit. You'd think sooner or later we might have to deal with that. And then who do we want to pay that? The rich people. So the estate tax exemption is not locked in stone forever where it is now. Obama would like to lower down the exemption to the number he's talked about throughout, which is $3.5 million. That's not even so bad, really. But he's not gotten any traction on that. So right now, what I understand out here in Great Falls, Montana, is that we can base our planning for now on that exemption amount. And as we'll kind of getting ahead of myself, when I look at that number, I think, okay, if someone has $5.2 million, we better plan for the estate tax, because people don't spend enough money to spend their estate down when they get to this level. Their estate's always growing, and it's usually growing faster than the exemption's going to grow. So the number I'm using is $4 million. Now, of course, that's age dependent also. But when I'm meeting with people, I'm saying if your estate is less than $4 million as a single person, or $8 million as a couple, probably we don't need to worry about the estate tax, at least as a primary goal or primary obstacle to plan around. And the exemption is for estate tax, gift tax, and then a third tax that we don't talk about all that often, generation skipping transfer tax. I just talked about what it means for estate tax. During your lifetime, you can give away big gifts of right up to that exemption amount, no tax. If you've given away more than $5.3 million during your lifetime, then the next gift you make, a large gift, you'll pay gift tax. And the only person who pays gift tax is the giver, not the recipient. The recipient gets the gift, it's not income to them, they don't pay income tax. The only person who pays tax, maybe, is the giver. But during your lifetime, you can give up to $5.3 million before you have to worry about gift tax. As I said earlier, the tricky part is the gift tax and the estate tax are kind of tied together. So you may give away $5 million during your lifetime, no gift tax, but when you pass away, your trustee needs to value what you have and then trying to figure out the tax based on what you have plus those big gifts you made. So you died with $5 million, you gave away $5 million. When Uncle Sam figures out your estate tax, he'll base it on a $10 million estate. Subtract the exemption, in this case leaving $5 million, and then $200,000 or $2 million check if you don't mind. The last tax is the generation skipping transfer tax. We don't focus on that too much, but that's a tax that comes into effect when you skip your kids and give it to your grandkids. Or you skip your brothers and sisters and give it to your nephews and nieces. And Uncle Sam says, fine, you can do that, but in addition to any estate tax you may owe, I want a tax there because you've cut me out of some money. When you give it generation by generation, I, Uncle Sam, can get a cut at each generation. Well, you skip a generation, fine, but I got to have my tax to make up for that. The nice part of it is, with this new law that went into effect last year, once again, we got a $5 million exemption before that tax kicks in. So for those few of our clients who are giving directly to the grandkids, until you give $5 million to your grandkids, we don't have that tax. So really, it's all good news. Yes, for a lot of our clients, we still have an estate tax issue, but that law change was great. I want to talk just for a minute about, go back and circle around to the gifts. I said 1 minute ago that during your lifetime you can give $5.3 million before there's any gift tax. That's your lifetime exclusion. That's one rule. Then there's another rule that says in any given year, there's another number, $14,000. And I don't know how many times I have this discussion every week. People come in and say, how much can you give? Isn't it $10,000? Says you can give whatever you want. When you give more than the annual gift tax exemption, we need to keep track of that excess because that excess is going to go to the $5 million lifetime gift tax exemption. So this year, if I give Hannah $14,000, I don't have to file any gift tax return, and she gets it tax-free. I don't pay any tax. We're good. Next year I give her another $14,000, same deal. If this year I gave her $100,000, then Uncle Sam says, fine, no problem, you can give away more, but you've given away more than $14,000. That excess, you, Keith, need to keep track of. And when that excess, added up through the years, gets to $5.3 million, the next time you give Hannah something more than $14,000 a year, I need my 40%. So those two rules, the lifetime exclusion amount, $5 million, the annual 14. All the 14 means is that the first 14 is free. Best tax planning you can do. Give that 14 away, and you can give it to as many people as you want to. Give it to the whole city of Great Falls. No tax consequences. As soon as you give more than 14 to an individual, then you need to keep track of that excess. If it's a couple, each couple can give $14,000 to an individual, and you're allowed to do what's called gift splitting. So if husband gives more than 14 to somebody, when you do your computations, you can say, well, we're going to treat that as given half by wife and half by husband, even though it came out of husband's account. So in effect, a couple can give not 14 per recipient, but 28,000 per recipient. Russ, question?
Okay, so let me repeat what you said. So that's 14,000 per individual.
Per individual recipient. Yep.
Recipient. Okay, that's just not aggregate. Okay.
Make sense? Okay. So I'm spending some time on this because people. Question?
You don't have to keep track of the 14,000
Nope.
at all anywhere.
Nope. Nope. Now, a lot of people are making gifts of property where the value is a little dicey. We think it's 14,000, but somebody else might say it's 20,000. Or we have had an appraisal done of maybe a minority interest in a business, and the appraiser has said, well, you know, if you just divided the assets up into shares, it'd be worth $25,000. But you're just giving 5% of the stock in this company, and nobody would buy 5% of stock in a company because you can't control it. They wouldn't pay $25,000 for that. They'd only pay 15 or 14. So you give them the stock, and you say it's worth 14 because you got that appraisal. Well, if you're smart, if you're talking to me or your accountant, they're going to say, you know what, it's a $14,000 gift. You do not need to file a gift tax return. But why don't we file one anyway? And we'll attach that appraisal. Because once we file a gift tax return, the clock starts ticking for Uncle Sam. He's got 3 years to challenge that. And if he doesn't challenge it, it's worth $14,000. It's not worth $25,000. So we want to put Uncle Sam on notice that we did a gift. We think it's worth $14,000. The appraiser thinks it's $14,000. And if you don't think it is, come now. Don't come and bug our kids 20 years from now when they don't even know what you're talking about. So in that case, you would file a gift tax return even though it's 14 or less. But otherwise, no requirement. Make sense? So, and then if you do, so let's just say you give more than 14. What are you going to do? The next year when you file your income tax on April 15, you have your accountant file a very simple little gift tax return. It's called a Form 709. It says during this year I gave X amount. Of that, certain amount was above the 14,000. In prior years I'd eaten into my $5.3 million. Now I've eaten into my 5.3 million, a million, 20,000 or whatever it is.
Keith, it seems to me that the issue is the value of the gift you're giving.
Mm-hmm.
How is it determined, say land or whatever? Is that what the concern is?
The whole area of valuation is a huge area in taxation. And the basic proposition is, if there's a ready market for things, we're done. You know, if it's a share of Coca-Cola. If it's an asset that the value is not publicly known, you, taxpayer, have a duty to come up with a value. And if you're going to use an appraiser, or that you need to use an appraiser, and if you're going to use an appraiser, it needs somebody, in effect, who's in this business, who knows what he or she is doing. And what you want to do, good practices, you get a good appraiser, and you tell them what you're trying to do. I mean, there's no secret about that. Well, here's what we're going to do. So they'll come back with a number, and if you don't like their number, you don't have to go with that. You just say, thank you very much, pay them their bill, and forget about it. Go to another appraiser or do something. But if you're good at that number, then you want to put Uncle Sam on notice of it and see what he has to say. A big issue within valuation is this discounting I mentioned. It's totally legitimate because it makes economic sense. You're going to give somebody 1% of your company, you have the other 99%, they have no voting control, you've never paid dividends, so on and so forth, they can't liquidate it. It's not worth 1% of whatever the land is that you have out there. The law recognizes that. The question is, well, what should the discount be? Should it be 15% or 95%? Paul?
Just for clarification, we have a business. So if I have a CPA firm give a value of the business, does the CPA firm only gives the value of the business as an entity, as a total. Then your firm then says, well, we can discount the 1% this amount, or the 5% this amount. I'm asking, do you ask the valuation person to discount it, or does your firm do the discounting?
Our firm does not do the discounting. What you do is you'll go to your accounting firm, and you'll say, we want to start a gifting program for all the reasons Keith talked about up in the Davidson conference room. And we're thinking about this asset. Can you help us value it? A CPA, in and of, given his certain or her designation, does not mean they're an appraiser. Some CPAs have further training and further designations to allow them to give appraisals. Right. They say, yes, we've got somebody, we've got Dave Wilsey, we've got Dan Vukovic, we've got somebody who not only is a CPA, but they're an appraiser. Right. Then we go to Dan and Vukovic, will say, and we say, Dan, we've got this business, it owns land, it owns buildings, it owns some equipment, it's had this income stream over the last 30 years, will you give us a number, what it's worth? He'll say, be happy to. Dan is then going to go to a real estate appraiser to get the number for the land. And he's going to go to the Blue Book to get the value for the truck. And he's going to, in other words, he's going to go to somebody who knows the expert, who knows the numbers of the component assets. Then he's going to say, okay, that's given us a total of $10 million. We're looking at 2% of that. Valuation specialist, am going to come up with a discount.
So they go up with a discount.
Yep.
Yep. I have a question on documentation of your annual gift tax exemption. Do you need to document if it's the 14,000 or under?
You do not. There's no requirement. I'm saying, though, that if there's a question as to the value, you might be smart to do it, but you're not required. Because, okay, yep. The tax law last year was portrayed in the Wall Street Journal and so on as horrible because it includes all these really high tax rates. True, but they only apply to people who have very high income. And most of us, if we're lucky here in Montana, we've got maybe some assets, but we don't usually have these huge income streams that they have in New York City. Some do. It's a good problem to have. I'm not going to spend any time talking about them. You'll see that in the outline. And basically, we've got a new top income tax rate of 39.6%. If your individual income is more than $400,000, or as a couple you have more than $450,000. There's a new 0.9% tax. There's a new 3.8% tax. If your combined income as a couple is more than $250,000. I'm not saying it's not an extra tax, but it doesn't affect most people. I want to switch gears and say we've talked about the federal estate tax We talked about the federal income tax. I'm going to circle back around to the tax again when we come to strategies. But I want to spend just a second on long-term care planning. People in this room probably are not going to do long-term care planning for themselves. Because by long-term care planning, I mean doing planning so that if we have horrendous medical expenses, nursing home expenses, we don't lose everything. That's a huge worry for people. Probably people in this room. People in this room probably have ways to deal with that. If you have an estate, I say between about $200,000 or $300,000, maybe up to $2 million, you might want to think about doing long-term care planning. The basic planning we've done are revocable living trusts. Because they're revocable, don't address that issue. So we want to do this planning. If in addition we want to do long-term care planning, we'd do something else. I'm not saying anyone here would want to do that. But a lot of us have family members and friends for whom this would be appropriate. And a lot of us have family members and friends who are veterans or whose spouse was a veteran during a time of war. People all know about Medicaid. Very few people know that there's a special benefit for spouses of wartime veterans and wartime veterans. It's called aid and attendance. And it's a really neat benefit because under the current law, unlike Medicaid, you can transfer assets, you can do planning today and go in and apply for the benefit tomorrow. No problem, there's no look back period. There's no asking what happened the day before. With Medicaid, we have a 5-year look back period. Doesn't mean we can't do some planning, but we need to work around the 5-year look back period. For wartime veterans, no. And the great thing about this benefit, it's not just covering nursing homes, it also covers assisted living facilities. And that's not usually true of Medicaid. So it's a neat benefit. Now, it's capped. Medicaid can be paying $8,000 a month. This is capped. And the maximum benefit per month is somewhere around $2,400. So we're not going to just think about that. But a lot of the planning we've done for people, we've said, okay, you've made some gifts within the last 5 years. You're going to be ineligible for Medicaid for a period of time. But during that interim, maybe you can get some aid and attendance and cover part of your facility expenses. Well, the big change we thought this year was an act to change the aid and attendance to make it look like Medicaid, to have a look-back period. In this case, they were proposing 3 years. There were hearings on this. I don't know if you saw in the paper, earlier part of the year, there was all this discussion about how people are taking advantage of the system and so on. It really looked like there was going to be a change. Turned out there wasn't. So this planning is still available for wartime veterans. And again, most of them don't know about it. So just file this away in the file this away in the back of your head for that discussion with Aunt Sue, and she's talking about Uncle Bob needing to go to the nursing home.
Did you say it was also for spouses of
Yes.
wartime veterans also?
Yes. Under certain circumstances, yes it is.
Okay, so if my mother's 87, she's doing fine. My dad fought in World War II.
So
Would she be eligible then?
he has to be eligible before she is eligible.
He's dead.
So she should be eligible.
Okay.
I mean, if she meets the criteria. Yeah. Questions, Hank?
So the look back period outside the veteran scenario is 5 years still?
Mhm.
Yes.
Yep. Yep. I'm happy to say we don't have many Montana law changes to worry about or even talk about. We're really lucky in Montana. Since the turn of the century, we've had no inheritance tax or estate tax in Montana. And I haven't heard any rumblings about reinstituting it. That's great. A lot of states do. We don't. One problem we have in Montana is that we're such a small state. Our legislature only meets every so often. We don't have a lot of laws. There's a lot of things that had never been ruled upon. That may not sound like a bad thing to you. In a way it's not, maybe.
Good.
But it causes problems. It causes problems because, for instance, we had a case involving a family out at Loma. They had a trust within a will done, I'm happy to say, by another law office. And you know how, if you looked at your planning and if there's a bypass trust in your planning. It's about 3 pages long. Their bypass trust was about, well, 8 lines. No details whatsoever. Okay? That was just fine until Dad died, bypass trust is in place for Mom. Mom has dementia. She's in Missouri River Manor. And the farming arrangement, after 15 years, fell apart. And some family members wanted to sell, and some wanted to keep it. And nobody knew if they were allowed to do that or not, because the trust didn't talk about it. They didn't have a trustees' powers section like your living trusts do that goes on for about 10 pages. The bypass trust itself didn't talk about it, and there's no Montana law on it. 0. So we got involved in that, and we were researching the law in New Hampshire, New York, Delaware, trying to get some guidance for the court. It was really interesting intellectually for me, not so good for the family. Would have been way better if we had a trust code that said trustees have these powers, unless the trust agreement doesn't allow it. So it can be good to have extra laws. Well, we have a new law in Montana as of October 1st called the Montana Uniform Trust Code. There's an organization actually based in Philadelphia of lawyers and judges and law professors that look at different areas of law and try to make them more uniform. Because we have 50 states and 50 different laws. And it's great for the lawyers, but it would be better if we had a little uniformity. So this group tries to figure out what can be proposed to different state legislatures to make laws more uniform. Well, they came out with a trust code about 5 years ago. The problem was they got a little ahead of society and the laws, and the trust code was a disaster. The law professors loved it, but people who do trust work and people who have property hated it because it was doing away with most of the protections of the trust that the English law and American law has given us for the last 500 years. Bad. So it came up for discussion in the state bar group here, and everyone said no. Well, then a group got together and said, okay, if we're going to, it would be good to have some laws in some areas if we would have this, if we have our law be more consistent with the protections we want to have for trusts, not just go off in left field. So this group got together and took this uniform trust code and wiped out most of the lousy provisions, and where we had Montana law that we were happy with, plugged it in. Got passed by the legislature last year, went into effect October 1. It's a good thing. It gives us some guidance, so if we do have a fight, yes, we always go to our trust agreement. We want that trust agreement to have as much detail as possible, because if the trust agreement covers it, we're done. But if it's not covered in the trust agreement, we can at least go look in the Montana Code, Uniform Trust Code, and go to page 14, get the answer. We don't have to have World War III. Well, the Uniform Trust Code has some requirements that are going to impinge on how we do our work. For instance, somebody passes away and what was up till then a revocable trust becomes irrevocable as to part of the planning. Well, when someone's appointed to the trusteeship of an irrevocable trust, they need to give notice to the beneficiaries in 60 days. Okay, that's not a problem. That's a new rule. We have things like that that give us some specifics. We're going to incorporate that into our process. You don't need to worry about it. For the first time ever, Montana law specifically recognizes revocable living trusts. Because the law hadn't been updated for umpteen years, there was no mention whatsoever. Now there's a specific section in there that recognizes, hey, that's the state-of-the-art kind of planning. We're going to enforce it. We're going to employ the rules that apply to wills when we look at trust to the extent it makes sense. That's good. From a practical standpoint, one of the best parts of it is they said when people who have a trust are confronted by a bank or an investment company that says, yeah, we'll be happy to open an account in the name of your trust if you give us a copy of the trust. Now they can say, well, Montana law says we can give you a certificate of trust that says there is a Bill Farron trust, I bill him the trustee, my social security number is the trust tax number, signed Bill Farron. You, Mr. Bank, can take that in lieu of the whole trust and be happy. We've been telling the banks that they need to do that, but it's a struggle. And some of you have had that struggle. Well, now the Montana law says right there, they're to honor that. The only difference is now they want to have the address of the trustees. We can handle that. So we've used that. We've used that with a company, again, up in the Flathead, who was not going to allow us to transfer the shares in a small privately held company unless we gave them the trust. I sent them a copy of the new statute. I sent them a certificate of trust. Problem went away. So it may not seem like a big deal to you, but it comes up every day in our planning. Guys in Helena sometimes can do things right.
So Keith, question on that. Is the reason the banks originally wanted the copy of the trust is they just wanted like stuff that's none of their business type thing? Or?
Well, you know, everyone is afraid of getting sued, of course.
Right.
So in a trust, they want to know, well, who has the authority to do these things? You know, so do they have the authority to open a bank account? And then who is the one? Does it have to be two people to sign, or can it be husband or wife? Or that kind of. That's legitimate, and that's what the certificate of trust says. Now, do they want to? Do they have some motives beyond that? They're probably kind of interested to know. They always, you know, every financial advisor always wants to get more into your pocketbook. They want a higher percentage of your assets. That's just their business. That's not saying it's bad. That's what they want to do. Well, same thing with the bank. They'd like to get more. They'd like to know more about what's the value of that security. What other, you know. So I'm not saying that's not possible, but anyway, we have a little bit more ammunition now to keep some of the privacy, which is one of the reasons why we like trusts. There's Bill Scott, my senior partner, now deceased, my father-in-law. And I like this picture. And I'm putting his picture here because some of my fondest memories in the practice of law are walking into his office, particularly when we were over in the Montana building, with a legal issue, maybe about 4 o'clock in the afternoon, and sitting down and chatting about it and just having this really great discussion. I mean, hopefully well informed in the law, but also very practical, very what makes sense on the ground. That was Bill Scott. He was a very bright person, but he was so practical. It was always the nuts and bolts of it. What made sense? I got a lot from that. And when I think about strategies I'm proposing to you, I want to remember Bill Scott and not be talking just about all these great legal theories, but what makes sense given what's going on right now. Well, when we look at the strategies that we're facing now after the American Taxpayer Relief Act, as I said earlier, for tax purposes particularly, I think we look at people who are probably not going to be subject to estate tax and those who very well could be. John and I are putting the magic number at about $4 million for an individual, about $8 million for a couple. But it's variable. If you're younger, you got more time to grow your assets. You're out there buying and trading, and maybe $4 million is too low. It should be, or too high. Maybe it should be $3 million, or for a couple, it should be $6 million. But anyway, if we think the odds are we're not going to be subject to estate tax, then we don't have to worry about estate tax. But our friend Mr. Income Tax has not gone away. So the main lesson to be learned for people concerned about the tax aspects of their estate planning, if they have an estate below about $4 million for an individual or $8 million for a couple, is now we need to be really thinking about income tax. And the big issue for income tax is what's called the step up in basis. So some of you probably are totally good at this, but it's complicated enough I want to spend just a minute on it. So the basic proposition is in estate planning, somebody dies and leaves property to somebody else. That inheritance is not subject to income tax. I don't care if it's $100 million or $2. When I receive something from my dad or my grandpa as an inheritance, no income tax. Unless it's an IRA, then when I start taking out the IRA, just like any other holder of an IRA, I'll pay income tax. But the asset itself does not generate income. So we don't have to worry about income tax when we first inherit. It's when we sell assets that we inherited that income tax gets to be an issue. Because I inherited a 1933 Ford from my dad. My dad was there in Dutton in 1934 when Strand learned how to drive it out there. He'd driven a Model T before. It was too fast a car for him. Went to Texas, never took it out of second gear. Went too fast. So I know a lot about that car, and my dad bought it from Strand in 1948 and kept it for me. Okay, that car was, I think, $600 and some when Strand bought it. When I inherited it, it was probably worth about $7,500. I'm going to say it's worth $10,000 now. That's just a guess. Well, when I inherited that from my dad, no tax, no matter what the exemption is. It's not income, it's no estate tax liability, there's no income tax liability. In his estate, that's one of his assets, needs to be valued. So you don't go to the Blue Book for 1933 Fords, but you come up with a value. And let's say it was $7,500. I turn around the next day, I would never do this. My dad would roll over in his grave if he knew I was doing this. And I sell it for $10,000. Then I've sold something for 10. It was originally bought in 1934 for $625. My dad bought it in 1948. I don't know what he paid for it, maybe $2,000. When he died, it was worth $7,500. Now I've sold it for 10. Well, what number are we going to use to figure my gain? Uncle Sam says when you inherit something, to figure your gain, look and see what it was appraised for in your dad's estate. You can use that number. I don't care what your dad paid for it. I don't care what Strand paid for it. It's what was it valued at in your dad's estate? $7,500, sold it for 10. Okay, you got $2,500 a gain, and the capital gains rate's about 21%, state and federal. Okay. When my dad bought the car, let's say he bought it for $2,000, that's, if he had sold it during his lifetime, he'd figure his gain based on the $2,000 that he paid for it. That was his income tax basis. When I sold it under this scenario after he died, I didn't sell it for what my dad's basis was. I sold it for what the basis was when I inherited it from him. Because Uncle Sam says, when you inherit something, to figure out your gain, you can step up the basis from what your dad paid for it to what it was worth when your dad died. That's the step up in basis. Uncle Sam doesn't give us too many gifts for tax purposes. That's one. So what that means for our planning generally, and I've had this discussion with some of you, all things being equal, be better for Keith to inherit that 33 Ford than to have Dad give it to him the day before he died. Because when Keith inherits that 33 Ford, his basis has been stepped up to what it was worth when his dad died, what it was appraised in. If my dad gave it to me the day before he died, it was worth $7,500, probably the day before, just like it was the day he died. I sold it for 10. I don't get to use that $7,500 for a lifetime gift. I need to use what he paid for it back in 1948. I'm saying $2,000. Lifetime gifts, we don't get that step up in basis. So all things being equal, your kids would rather inherit a certain appreciated asset from you than get it during your lifetime, because they won't have any tax right then. But when they turn around and sell it, they'll pay more capital gains because with a lifetime gift, they didn't get to step up the basis to what it was worth when dear old Dad died. Make sense? Okay. So now that for these estates, we don't have to worry about estate tax, this is the big tax issue. When we're giving property to our kids, if it's going to be property that's appreciated or has already appreciated, we'd like them to be able to take advantage of that stepped up basis. So if they sell it later, they'll pay less capital gains. Well, the big issue in all of our estate planning is, just like me, if it's a couple, I said, if I go first, we'll figure out what the estate tax exemption is. We'll put most of my property for Becky in this bypass trust. Won't be taxed, estate tax when I die. And when Becky dies, goes to Hannah, no estate tax. No estate tax. Income tax-wise, when I die, the assets go down to this bypass trust, they're appraised. And that sets a value for those assets. And then when Becky dies, goes to Hannah, they're not appraised again. When Hannah sells those assets later on, it's not what they are worth anytime that Becky outlived me, it's what they're worth when I died. We don't get a step up in basis based on Becky living another 20 years. So the bypass trusts out there in the world, when this tax law changed last year, all of a sudden the red flags started flowing. Do we want to use a bypass trust? Because if the second spouse lives a lot longer, all that appreciation of that asset during the time she was alive doesn't help our kid, doesn't give him a more of a basis. Because we set the basis back when poor old Keith died prematurely. That's the big issue for estate planning that people who don't have an estate tax issue need to consider. I'm happy to report that in your trust, we already dealt with that. And the way we dealt with it is, in your trusts, there's a provision, we never talked about it because we weren't really worried about it, that says if Becky does outlive Keith 20 years, she needs to talk to Keith's younger partner and need to look at what assets she has and need to pull the trigger on what's called a power of appointment so that when Becky dies, the basis that Hannah can figure on is that value when Becky dies. So the magic words are power of appointment. There's a power of appointment in your bypass trust that if you elect that, if the surviving spouse, in this case Becky, elects that, then when she dies, those assets will be treated to the step up in basis. So I guess there's a couple points here. The first point is you can all take a deep breath, because even if we don't have any estate tax issue, we can avoid this income tax issue. That's the great part. But the second part of it is, if the second spouse lives a long time and there's a lot of appreciation, that second spouse needs to be minding her P's and Q's and talking to her advisors and pulling the trigger on that power of appointment so that she'll get a step up in basis, not only a step up when Keith died, but also when Becky died.
So when do you do that? You're saying you need to pull the trigger on it. When does that spouse do that?
Okay, so I get hit by the bus tomorrow, and Becky lives, she's doing great at age 80, probably before age 80. Some point in there, she needs to join the Peace of Mind Protector program. And as she's talking to Keith's successor, John, or whoever else has joined the firm, that issue needs to be addressed from time to time. And what the discussion is going to be is, Becky, remember that bypass trust that you got from Keith? Well, it's got $1 million in it. And part of that is Coca-Cola stock that's gone up way, way, way high since Keith died. We need to decide whether we'd want to exercise that power of appointment or not. Becky says, what's that? I said, well, it's a trigger in your bypass trust that says Hannah, if she ever sells that Coca-Cola stock, can pay less capital gains because she'll base her gain on what it's worth when you die, not when Keith died 20 years ago. Okay, I get that. Well, what are the other factors? Well, if we pull the trigger on that power of appointment, that means the assets in the bypass trust, or whichever ones we exercise them on, are treated as part of Becky's estate. So if Becky's looking at estate tax exposure, we just save some possible capital gains for Hannah, but maybe there's going to be some estate tax. So Becky needs to be talking to my counterpart to say, am I worried about estate tax? How big's my estate? How big is the exemption? And if it looks like I might have estate tax, what's the estate tax rate versus the capital gains we're going to save for Hannah here? How does that play out? If Becky doesn't have a big enough estate to worry about estate tax, or maybe there won't be any estate tax then. Then definitely we want that asset to be in her estate. We want to pull the trigger. And my successor is going to say, you have that power of appointment, let's just exercise it.
So do you just pick a date, like say you live 20 years longer and you're at year 15, do you say, we better do that? Do you have to quantify that at some particular point?
There's no right or wrong answer. No right or wrong answer. Now, I'm simplifying this a little bit because this bypass trust, one reason, well, let me take a step back. I put on a presentation, maybe some of you were about a year ago, talking for the first time about this tax act, talking about this bypass trust. And I said, a lot of you guys whose estates are under about $4 million don't need to use a bypass trust anymore. You might not want to use one because it'll be an extra taxpayer, it'll be a little extra complexity. That's the downside. The positive side is, remember that bypass trust has a remarriage provision in there. It says that if the surviving spouse wants to get remarried, A-OK, but they need to get a premarital agreement with that new guy or gal to protect that money that poor old Keith earned all those years. I had that discussion with probably about 15 families that didn't have an estate tax exposure. None of them want to get rid of the bypass trust. Zero. Because they realized the bypass trust wasn't just about taxes, it was also about protecting those assets. One of the people we're protecting against is the new husband, the new wife, and their evil stepkids and so on. Well, okay, so we're down the road and Becky gets remarried and everything's great. And we don't feel there's any fear about taking out of the bypass trust and putting it over in Becky's name and she can do whatever she wants to. That's one scenario. Or it is an evil new husband and he's doing whatever he can to squeeze that money out and give it to his kids in Puerto Rico or wherever. Then probably we don't want to exercise that power of attorney. We'd rather keep it in there and keep it protected so that, yeah, I can't handle it to pay higher capital gains down the road, maybe if she ever sells it, but at least she got it in the first place. Didn't go to Puerto Rico. So it's not a real yes or no answer. And maybe I'm going way too far down this road today. But the point is, as we're going through our lifetimes and as tax laws change, there's a trigger in this bypass trust that might be really advantageous tax-wise. We may or may not want to exercise it. And it'll depend on what the family circumstances are. So that's why I think in this case, Becky would be smart from time to time to stay on top of it. Good lawyerly answer, maybe. Well, okay, so we've talked about the bypass trust. There's the remarriage provision slide. Every family that I've talked to about this, and I'm including people, I don't know, what's the youngest family we've done planning for, trust-based planning? Maybe in their 40s? Maybe?
Oh, no.
In their 30s?
Yeah.
Okay, I can't think of any 30s. But anyway, from the youngest to the oldest, whenever I talk about this remarriage, they all totally get it. And usually the wives get it better than the husbands.
We have a young doctor that's got kids that are like 4 and 5.
Yeah. Yeah. Anyway, my point is, people really see that. And yes, remarriage of the surviving spouse, of course, when we're talking about good planning, we're thinking about our kids maybe having marriages that don't work out. And trying to keep the money the dear old dad earned going up and down all those stairs with that furniture all those years in the Farron family as opposed to someplace else. Okay, well, many of you have estates where estate tax is still going to be a major concern. What kind of planning would we do there? There's a couple aspects. First of all the concerns that people have who don't have estate taxable estates, we need to worry about that. We need to worry about the remarriage. We need to worry about all the aspects of trust protection, so on, that people who don't have tax issues do. Gifting. In your outline, you'll see I talk a little bit about gifting. And I want to spend a second on that. I talked earlier about the two rules. And I said, we have this lifetime exemption, we got this $14,000 annual exemption. Well, in the world of estate planning, all it's been beaten into our heads, we ought to start giving things to kids during our lifetime. That's good planning. For people who have an estate where estate tax is going to be an issue, that's still really good tax planning. For people in that first category who have estates where we won't have estate tax, we don't need to do it tax-wise anymore. Because the reason we were doing that gifting was to get it out of your estate when it was still worth $10 a share, instead of keeping it in your estate till you die when it's worth $30 a share. Because we'd rather pay tax based on $10 than $30. Getting assets out so the appreciation isn't in your estate, it's at your kids' level. That's still really good planning for people who have estate tax exposure. The people who don't need to gift from a tax standpoint. Now, there can be a lot of other good reasons to give for those people who are not worried about estate tax. One of them is they're concerned about long-term care expenses. They want to get that 5-year window going so that if they ever do have some nursing home expenses, at least part of their estate they've been able to get to the kids. But for people with the smaller estates, gifting doesn't really have a tax advantage. And as I said, lifetime gifting, we don't get that step up in basis. Actually, from a tax standpoint, can kind of zap us to have made lifetime gifts. People with larger estates were more worried about the estate tax than the income tax, because usually the estate tax has a higher rate. And lifetime gifting continues to be a really big strategy. And the best strategy is that $14,000. If mom and dad can afford to start giving the grandkids or the kids something every year under $14,000 or $28,000 per couple, that's the best tax planning that you can do, because it gets out of your estate, the kids can benefit from it, it's no income tax, no gift tax, we never add it back in. Only do that if mom and dad can comfortably do that. We don't give things away for some tax reason when it comes back and we lose control and feel like we made gifts we wish we hadn't made. If we have estate tax exposure, gifting. Then, right now, and for the last couple of years, we have historically low interest rates. And it's really weird. I'm not saying it's good, but in one sense, it's really advantageous for people who want to minimize their estate tax. Because Uncle Sam, he came up with these rules back when we had higher interest rates. And he said, if you want to do certain transactions, I'm making you use an interest rate that I'm going to come up with called the applicable federal rate. You got to use that. And if it's a very short term, you use a short-term rate. If it's up to 9 years, you use the intermediate rate. If it's more than 9 years, you use a long-term rate. You got to at least use that, or I'm going to impose some extra taxes. Well, that wasn't very good for us back then. But now, those rates get set every month, and the short-term rate has been like less than 1%. So now we could sell an asset to our kids, an installment sale, and make them pay 1% interest. And Uncle Sam, he's got to live with it. He had to live with it in the good days of a high interest rate for him. He's got to live with it in the bad days, at least till Congress changes something else. So for people who have estate tax exposure and for whom it makes sense to transfer assets to do gifting, we don't have to have it be just in the form of an outright gift. It might be a transaction where it looks like a sale, but at very low interest rates. Okay? Then, at the very end of your outline under the strategies, I talk about some specific kinds of trusts. And if we want to talk about them, great, but otherwise, I'm not going to go into detail right now. We lawyers love these trusts. One's called, we call it a GRAT, Grantor Retained Annuity Trust. Another one we call an IDGIT, Intentionally Defective Grantor Trust. Another one we call a QPERT, Qualified Personal Residence Trust. Okay, I've read so many articles about that. I've been to so many seminars. It's great. How many are we doing in the office? I'm working on one right now. One. And we've had discussions in the past. We've looked at them really closely. People haven't done them. But they should, because the Uncle Sam rules that he put to really put the screws to us work to our benefit right now. One of the rules is he said you got to use the interest rates that I'm going to impose every month. Already talked about that. Another one is back in the 50s, people were using trusts in a way Uncle Sam didn't like. So he said, you know what, if you have a certain kind of a trust, I'm going to call that a grantor trust, and I'm going to ignore that for income tax purposes. So when you file your income tax returns, I don't care if you set up 14 of these grantor trusts, it all flows right to year 1040. How do you like that? Well, we didn't like it too much back then, but then we figured out some ways to deal with that. And one thing we figured out was, well, what if we set up a trust and made it one of these grantor trusts, so for income tax purposes it's going to be ignored? And then what if we had that trust buy our business from us? And that trust says, the beneficiaries of that trust are our kids. And we'll get the business appraised, and the sale will be at that appraised value, and we'll use those onerous interest rates you have, Uncle Sam. But since it's treated as the same taxpayer, it's a sale, but there's no capital gains. And there's interest being paid, no interest income. So it looks like a sale, this crazy sale, but there's no income tax consequences like a sale. It's another way to do a gift, even though it's called a sale. That's what we're doing for this business that I mentioned earlier, where we've got 2 kids involved in the management, some others working there. We're going to get the business appraised, and we're going to transfer to actually 3 of the kids 48% of the business, 16% each. And it's going to be through these trusts, so that we're going to sell based on the fair market value of the business, which is like around $6 million, but there'll be no capital gains whatsoever. It's a way of gifting to the kids without any estate tax, thank you, but also with no capital gains, with no income tax. Now that's pretty neat planning. The problem is to get your mind around that. So we've been talking about that with this family since last July. And about 3 months ago, they said, you know, we get this. Let's do this. So now I'm saying, okay, now I want to give you some specifics. Now let's get some numbers in here and let's really run through it and make sure you're good at the specifics. So it's kind of complicated, but for some people, it's a really neat thing. Not if you're not worried about estate tax, but if you're worried about estate tax and you know who you want to get that property, it's pretty good. So I want to conclude with this picture of this harassed-looking guy. I had this conversation with my partner John here a couple of years ago. We were talking about how we need to be always changing our our technology and joining elder council and all this. And about changing, and he says, "When's this change going to end?" That wasn't his greatest question ever. It's never going to end. Every day we've got change, and it's just so overwhelming. And particularly as we get older, we're a little less able to really get our mind around it. Well, estate planning is just like all the rest. And we can put our head in the sand. The comment I hear, well, I'm not going to be here, I don't care what happens. That's even a worse statement than John's question was a lousy question. I think, if you love your family and so on and so forth. But change is going to happen. So what do we need to do? We need to stay on top of it and adjust as we are comfortable. I love this program because it gives us a fighting chance to get our minds around some things, to go back, circle back around again and look at what we did, tweak that a little bit, and then add a little bit here. So for instance, I'm so excited about this next workshop to talk about, for people who want to do that, setting up their planning so that when it gets to the point, if it does, where the family has to decide whether they're going to hire the 24-hour care, that's going to be expensive. Going to put in the hospital bed, ooh, that's really expensive. The money's already been set aside, the conversation's already happened, and we already have people besides the son who has the conflict of interest, who would, every dollar we spend on the nursing home avoidance is the next less dollar he gets. He doesn't make all the calls in the absence of direction from Dad. Even though Dad's no longer able to control things, what Dad said he wanted when he was in Keith's office can actually happen. Well, again, we don't have time to talk about that when we first go through all this estate planning, living trust. But now from this program, we do. Some people want to do it, some won't, as an example. So I guess I wouldn't have started the program if I wasn't excited about it. I'm really happy that you folks see the value in it. We're meeting with new people now, the first time we talk to them, or like when they call Tanya on the phone, she says, well, I don't know what you say, but we're a little bit different. One part of it is we have this program to continually update your planning. We think it's really important. If that kind of thing makes sense to you, we're probably a good fit for you. In effect, what she's saying, if you're really worrying, about saving every last little penny and want just one quick meeting, probably we're not the firm for you. And that's I hope you're saying something like that. Yeah. Questions?
Keith, one of the things that, as you were talking here, that I think might be really helpful is a time when we talk to the trustees and talk to the trustees as to exactly what their duties are, where they find certain things, when they might pull that trigger, as you're talking about, because I know it's something I've not done.
Yeah. Well, and it's in my outline. I didn't mention this. We're not making any huge changes to our estate planning process. One change we are making as a result of this ethical will presentation that we put on is our 3-month follow-up meeting. We're including a discussion on that. And then, I guess kind of selfishly also in that 3-month program, we're asking clients if there's anybody they know who could work with us. Because John and I are horrible about asking for referrals. So I thought, well, if we put it right in the process, a specific meeting, maybe we'll actually ask for referrals. But as part of our process, during the first year, I hope I told you this, we're happy to host what we call a family meeting with either heirs and or successor trustees to talk about the planning. And not everyone takes advantage of that. Matter of fact, most people don't. Even though we talk about it each time, they don't do it. And a lot of times the kids they're not here, and it's kind of hard to get things arranged. But during the first year is a really good time. People in this program, if any of you want us to host a family meeting, no problem.
You could either do it Skype or telephone conference.
Sure, yeah. We're set up to do Skype.
Yeah,
Yep.
a lot of them aren't in the States.
Yeah.
So
And actually, one thing I want to do, Chris, is I want to have one of these workshops be on successor trustees, their selection and their duty. I've got some material. I haven't had a chance to put it together, but I want to have like a little booklet that we would give our daughter, we'd give our son, to say, we've named you as a successor trustee. I know you're going to be really honored, but here's a little bit more information. Yeah. Okay, well, I said I was going to leave time for questions with 90 minutes, so you've got 3 minutes for questions. Or comments. Bill, what was the most useful part of this?
The stepped up cost basis.
Mm-hmm. Yeah. I can see that. Paul, what would you say?
Well, it's always good just to review issues. So it gives me food for thought.
And one thing I had wanted to mention this. So the idea of our program is that at any point you have any questions, call. You paid for it. We'll get together. But toward the end of the year, we're going to specifically be asking you for information that's changed and when it's appropriate to meet. Does not have to be the end of the year, but that gives us a chance to make sure it's going to happen. And quite a few of you, when we first started the program, took advantage of that. Don't be shy about taking advantage of it at another time also. Our goal, my goal is that you see just like we don't ask for referrals, you see so much value here that you're referring everybody on your block to come in and talk to Keith Pitt. Nobody else does this because nobody else does this. But if we're not taking advantage of, we're not doing it, that's not going to happen. So I would like to bend over backwards to work with you to improve your plan, to talk about these things, because I just think it's not only going to benefit you, but selfishly it's going to benefit our firm too. So that's the